subscribe now and press the bell icon. Never miss an update.
As the name says, the earned income credit, it's obviously it's related to some earned income. And do we know the difference between earned income and unearned income? Who can say that? Shweta.
Passive income will be like unearned income,
Yes. And what is earned income?
which we earn
It
due
is
to
realized income.
like
What?
salary. W2 income will be
Yes, the earned income is the income coming from employment or self-employment or like any of the activity where personal efforts have been put in. For rental income, you don't need personal efforts. All you do is like buy a property, put it up on rent, and then you get rental income. Same thing with interest, dividend, capital gains, and all. It's not like we're continuously working on it. Okay, that's why they're called all passive income, and this is going to be active income because we actively work towards earning that on in day-to-day life and all. So the earned income credit, important thing is this is refundable. As the name says, there has to be some earned income. And this credit is very, very important. This is a refundable credit. It can give back a very significant amount as refund. So IRS is very, very particular about it. They want to make sure nobody is like messing around with this and not taking undue advantage of this clause. So, and obviously the credits are given only if the income is below certain threshold. So there has to be an earned income. The income has to be below certain thresholds, and that's how the taxpayer will get eligible for earned income credit. There are certain other requirements as well that the SSN has to be there. ITIN people, they do not qualify. This is a very special credit meant to be only given to Americans or the residents. IT people on ITIN, they might be residents, but they don't have the proper visa to work there. And typically people, those who are dependents, like the those who are migrating from one country to like come into US, and maybe one person is the got H1B visa, the entire other family members could be on dependent visa. So those people, they get ITIN, they don't get social security number, so they are not qualified for that. There usually, if there is a qualifying child, they get more amount as credit, but it's not needed that they need to have a qualifying child. It just increases for individuals having at least one QC. Again, this is not something new. People, those who file separately, they're not given this benefit by IRS. So the whole thrust, the whole inclination of the government is again and again that try to file joint returns. Married filing jointly is the best category to go with. Those things, separately they don't. They just lose most of their benefits. And again, maybe one of the reason is to keep the family intact and all, and have joint income and those things. So obviously the credit is not available for taxpayers who fraudulently claim the credit. I don't know if there is any law which says the benefit is available even if you fraudulently claim that. This sentence was really not required, but as per the law they have put in there. Anything that we claim fraudulently is not allowed, whether it's credit or it's deduction or whatever it is. IRS may request, this is very important. So if we are claiming this credit for a client, remember there's a lot of responsibility on us as a tax preparer. We should be 200% sure that they are really, really, really eligible for that. Because those kind of returns will definitely get picked up, or IRS may want to look closely into that. They may ask for documents, give us the proof on what basis you're claiming, and all those things. That's why they're clearly saying here the IRS may request all the documents. For the tax preparer also, they ask specifically certain questions that did you go through the documents, did you verify the credibility of that, did you have a do you have a reasonable whatever assumption that what that the credit that the which is being claimed by the client is correct. Okay, did you make any reasonable inquiries Did you document your inquiries? Did you check any of the documents that they have provided in order to claim that credit? So there are a lot of questions asked for us. So, and when we are saying yes or no to that, that means we are signing off. And anything given wrong information to IRS will put us also into trouble. So we cannot take that risk as well. And why they have made it more hard for tax preparers, so that again that's like a double check, right? So any preparer who's preparing the returns will not let the client claim EIC unless they 100% genuinely can claim it. For other credits, the requirements are not that strict, but this is uh, this is much more stricter. Another point is that although it's not very clearly said, but typically this credit is given to the people those who are staying in US, the principal residents in US. Especially an individual without a qualifying child must have his principal residence in US. But that would mean that the individual with a qualifying child can live outside US also, right? As long as the person is a US resident and or US green card holder or a citizen. But again, we will see down that for qualifying child, they have put residency as the test. The child must have lived in the United States. So we have had couple cases where we have claimed because this rule is not very clearly said, and typically what they say is like any US citizen will get the same amount of benefits regardless of whether where they're living, because regardless of where they're living they still have to pay taxes in US or at least do the reporting in US. But EIC is different. We have actually claimed EIC for some clients, those who are living in India, and it got picked up by IRS and they have rejected it. And after, we have also put in all these clauses that all the conditions are satisfied, but probably the residency condition is not. So now we should take EIC only for taxpayers who are living in US. So, okay, who is going to be a qualifying child? There has to be a relationship, there has to be residency requirement, there has to be an age requirement. Under age 19 or age 24 if the person is a student. Okay, there was some figure here. Let me try to see if I can get it. Or maybe after we go over this section, I'll get the flow chart. So child claimed by both parents. What they're saying is married filing separately is not allowed. But person can file as single or as a head of household. If they are like legally divorced or separated, they can go for it, and then they can have a understanding that okay, I'll claim the child, or I'll be the custodial parent for the child, or I'll be like as per the court orders or whatever, who gets to keep the custody of the child and all those things. So now this rule is basically clarifying that in the event that two or more taxpayers claim the same child in same calendar year, if that happens, I mean there could be different events, it could be a bit confusing, but if that happens for whatever reason, the child will be the qualifying child for the parents first, then for the taxpayer with the highest AGI. So it's quite possible that when we are looking for who is a qualifying child, we are looking for relationship. It could be a biological child, or it could be a foster child, or a stepchild. Okay, so if there are other people also who are claiming the same child in the same calendar year, the rule says that whosoever is the parent, legally whosoever is the parent, the child will be qualifying child for that. And then for the taxpayer with the higher AGI. If both of a qualifying child parents seek to claim the credit but they do not file jointly, then the parent with whom the child resides for the longer period in the year, that parent can claim the child for the purpose of EIC. And let's say the child is spending 8 months with mom or 4 months with dad, or the other way, vice versa. And also with whomsoever child is spending majority of the time, that parent can claim EIC. Otherwise, if the child is spending same time together, like six months with each one of them, then the person with the higher AGI, whosoever is earning more, that person will take. Why? Because IRS will obviously give less refunds. As the AGI increases, the EIC may come down. So that's in the interest of IRS to put it up like this, that the parent who is having higher income, let them claim. Because the parent if that parent is having a lower income, they will claim more in earned income credits. So, anyways, if you are not clear about the rule, okay, which parent should claim for EIC? First of all, is that with whom the child is staying, who is taking care of the child, and all. If again that is controversial, that okay, no, I am also paying half expenses, like the other parent is also paying half expenses, they're talking like that, then we can see where the child is staying for the most of the time. Even that, if they're coming to a tie and all that, okay, even that is not being very crystal clear, then go with which parent is having the higher AGI. So a qualifying child cannot file his or her returns. That's also one of the thing that they're saying, that the person has to be clearly a dependent. A taxpayer who is a qualifying child of another person cannot claim EIC. It's possible somebody who's even at the age of 24 or whatever, that person can be claimed as a qualifying child of somebody else. So then that child himself or herself cannot go and say that, okay, I need EIC because I'm filing my own return. The child can file their own return if they're having income. If the income is above certain threshold, child can go ahead and file the return. But for the purpose of EIC, if the child is a dependent of somebody else, then the EIC will only go to that person. The same rules are there for other dependent care, credit, and all those stuff as well. This applies even if the person for whom the taxpayer is the qualifying child does not claim the EIC or meet the criteria and all those things. So basically, what we are saying is, if the person is a qualifying child of somebody else, that somebody else will be only able to claim EIC. And that it doesn't matter whether the person is claiming EIC or not, because there is clearly a question asked whenever we work on EIC. Clearly, one of the, in the template or in that questionnaire, one of the question is, can the qualifying child be a dependent of somebody else, or can somebody else also claim that child as a qualifying child of on their returns? If we say yes to it, it straight away says no, you cannot claim the credit. Earned income, obviously, then now they're giving an example. What is an earned income? It could be wages, salaries, and all. And what is disqualified? Any interest, dividend, capital gain that is not an earned income. We have seen that. And what is the disqualified income? Um, that will lead the taxpayer to be ineligible for EIC will be 10,300. That means if a taxpayer is earning more than 10,300 or 10,300 in any of these passive categories, that person will not be eligible. What IRS is saying, that if you have so much of wealth or means to earn approximately $10,000 in passive income, that means you have enough money. It's not a small amount. So you have enough money, you're not eligible for EIC. You may choose not to work. You may say, well, I'm not going to work, or I just work 2 months in a year and my earned income is only, say, $5,000. But the unearned income is more than $10,000. Then you're not qualified because you're having enough of passive income. That's much more than child tax credit or any other credits and all. So this is little table that will tell us what is the maximum amount. Obviously, we all know about the phase out rules. As the income increases, the credits will go down. So this is the phase out table for EIC for the year 2022. We'll go through one of the examples, then it will be clear. But before we go through the example, let's just go over some of the other requirements. QC meaning qualifying child. So if there is zero QC, meaning there's no child, only say only two people filing or only one person filing and all, then the phase out amount is something else. Okay, and for joint filers, what is the phase out amount and all those things. For one qualifying child, it is increasing. For two children, it will increase more. For three children, it will be more because the income level can increase. The income is increasing, they are increasing the income limit because the family size is also increasing. So obviously they need more money to maintain the family. They will definitely need more income. But with three children, maybe at the end of the day, what they're saving is really less. So they may be eligible for earned income credits. There are certain requirements. There is a due diligence requirement which is on our part, which is as a preparer, we need to make sure, otherwise there's a penalty, that there has to be proper due diligence done. And what they're saying is there are 4 due diligence requirements imposed by the regulation. 4 requirements. Let's see what are the 4 requirements. We have to complete Form 8867. This is a form you will always see in our tax return. And here we are saying that we are truthfully and accurately and putting all our answers there. It's kind of penalty of perjury statement where we are signing and giving that, okay, whatever we are saying is truthful and to the best of our knowledge and all those things. So we can, as a tax preparer, we can be held responsible for just recklessly marking anything or carelessly going about it or not trying to verify the information. So this form is very important. Again, this is like a checklist which is given to us by IRS. IRS is asking a lot of questions. Did you make sure you have inquired with the taxpayer? Have you seen any of the documents? Which documents you relied upon? Was the taxpayer denied EIC in any time previous years? Maybe then that's again a red flag that maybe they have done something wrong. That's why they were denied. So all those questions we need to get an answer for our understanding and let the IRS know that yes, we have done our due diligence. Then there is a EIC worksheet that we need to compute. That's again second requirement. There's a whole like 2-3 pages worksheet which will again ask a lot of questions. That what is the status of the taxpayer? What is the income that they are earning? Do they have any qualifying children? Can those children be claimed as qualifying child for somebody else? And there might be some few more questions and all. Okay, yeah, where was their residence? What is the age of the child? There are 3 other requirements like age, residence, and relationship. So there might be questions around it. That's what the EIC worksheet is for. And we have to again go through it and make sure we are giving the right answers. After, if all the conditions are satisfied, then they will be able to get EIC. So we have to complete the 8867 form. We need to complete the EIC worksheet. We have to gather proper knowledge, like make reasonable inquiries. Do not ignore any other information given. Like basically, what they're saying is be reasonable in what you're doing and just be, use your complete 100% professional judgment and do things with full diligence. Because this is hard-earned money of other taxpayers, which is being distributed to the low-income people. So that money should not be misused. Somebody else is working really hard, paying to the government, and that tax is being distributed to other people. So we need to be very, very. This is a free money given. It should not be misused. That's why the requirements are very high. And record retention, that is the 4th part. We have to make sure we are saving the records for certain years, maybe for 3 years. That's what they're saying. It has to be 3 years from what date? From the date of filing, you can just take it. There are following due dates that they have given, but typically we can just go with the what is the latest date. Okay, the latest of the following due dates. So whenever we have submitted, if that is the latest date, then from that day you can count 3 years and make sure for next 3 years we are saving all the records and all the requirements. We do not need to ask them to give us the copy of their social security cards and all. That is not required. But we may need to ask them that if they are saying that yes, the child lived with them, okay, give us some proof. We should have some kind of proof, maybe school records or something else that says the child is also living on this address, same as taxpayer. The child is a US citizen or not and all, maybe we can ask them to provide us with a passport copy or some green card copy, something. We need to make sure that we are going over it and we are asking the taxpayer to provide that. Okay, any questions so far on EIC? Let's go over this example. Sakshi, can you read this for us and also try to explain it? 8.12.
Yes, please. Joe is a 50-year-old single taxpayer with
So
wages,
let's make sure we are putting our facts right. He's a single taxpayer, okay, with wages. Yeah, go ahead, go ahead.
wages $12,300 and $8,000 of AGI. Joe does not have any qualifying children and is eligible for the EIC. With no qualifying children, Joey's applicable percentage for the EIC is 7.65%. Joey's
Okay,
earned income of
let's stop here for a minute. So let's see what they're saying is if the taxpayer there is zero qualifying child, then the applicable percentage is 7.65 percentage. So that's why they're saying that's EIC 7.65. Yeah, go ahead.
Joey's earned income of $300 is greater than the amount required for maximum credit of 7320.
1 minute.
The high
See what is the maximum credit. So yeah, this is what the earned income amount they're giving this limit in the table that this is 7,320. So Joey's income is more than this earned income what they're giving here. His income, Joe's income is 12,300. It is greater than 7,320. Okay.
the higher of his earned income or AGI is $12,300, which is greater than the beginning phase out amount of $9160.
All right, so this is the phase out table that's what they're giving here. The beginning phase out amount is 9,160. So his income is the higher of whatever we take, either AGI or wages. So we are going to go with wages because that's higher than AGI, and that's obviously that is higher than the phase out amount. So now we need to see if the income was below that, he could have got full tax credit of $560, full earned income credit of 560. But now his income is above that, so some phase out calculations will apply, and maybe he'll get something below than 560 because he's into this category. Okay, so and this is for the single people. This is for joint filers. Okay, so which is greater than the beginning phase out amount of $9,160. Therefore, Joe's earned income credit is 1420. How they're doing it? We'll have to see whatever the income is below the phase out amount limit that they have given. His income is 12,300. It is higher by how much? This is what the calculation is being done here. Take 7.65 percentage of that, and the maximum he can take is $560. So, but his income is above the limit, so his credits will get reduced, they will get phased out. So 560 minus whatever, if you do all that calculation, it should come to $240. Right? That should be $240. So 560 minus $240 will be 320. That's the maximum he can claim as EIC. Is it clear?
Yes.
Okay. One another thing is, do not get overwhelmed by this. Okay, you're going to remember all these names and all again and again. I've been saying that's not the idea. This all calculation will be done. Any simple calculator you can pull up from Google, saying EIC calculator and all. Put on all these numbers, it can easily give you the answer. That's not what we are trying to learn here. What we are trying to learn is the taxpayer eligible for that? If yes, what is going to be the test, or what is going to be the eligibility criteria? And are we doing the proper work of due diligence? Are we making sure all the requirements are met? If everything is done properly, the calculation is a part of, like, simple program can do this calculation. That's not what we are focused on. But how it works, yes, you should know that why somebody with 3 children will get higher earned income credit, and this guy single with 0 children, he will get a lower amount, because we have gone through the rules.
No, but what my question is, why we are reducing it, why we are deducting it from 560? Because that's the maximum, no? So whatever is
Because-
coming,
Huh?
that's the maximum. $560 is the maximum.
Correct.
So why? So whatever is on the extra income that we are reducing.
Correct. Yeah, it is being
That's
phased out,
okay.
and this is the phase out amount.
Okay. So another thing is, we should not name the client here, but in case of Tejas, will it be applicable?
No,
Okay.
a
Why?
person who is a dependent of anybody else, they cannot claim earned income credit. So any student, any, like, that person is a child himself. I mean, he's having other income, which is okay. He needs to file his own tax return, but is still a dependent of his parents. So the parents can claim EIC, but not the kid.
Mhm. And if he is not claimed as dependent, then he will be eligible.
Yes, but again, the onus lies on us. Why he not be
Hmm.
claimed as dependent? How much income does he has? How can he support himself? If he is going to school, who is paying for his fees? If he has taken a loan, then that's different thing.
Hmm. Hmm.
But we should not get into these things unless it's a genuine uh,
Hmm.
situation.
Okay, got it.
Especially not for EIC.
Hmm. Got it.
Garima, what are the 4 requirements that one needs to keep in mind?
Ma'am, first of all, completion of Form 8867,
Perfect.
then computation of credit,
Yes.
then knowledge. Basically, the taxpayer is interviewed,
Yes.
and last is the record attention.
So let's start with the next one, residential energy credits. Again, as the name suggests, this is all related to renewable sources of energy and all, like, very good for Mother Nature and for the earth and all. So there has to be some incentive if people are going for renewable energy sources, which could be wind energy, solar, or something else, hydro and all. Okay, so typically solar is very, very popular because it's easy to get the solar panels installed in the home and all. So what IRS is saying, that if you're really spending so much amount for for making any energy efficient improvements on the property, then the expense which is being incurred for that reason, it will be qualified for some kind of credit. Now, how much it is, that and all that, we'll just quickly go over that. So there are 2 credits available in this category. That's what they're saying. It's available for individuals to improve the energy consumption on their residence. To improve the energy consumption, meaning you don't need to go ahead and put something brand new there. Simple things like making sure the house is insulated, because the weather is quite on extreme side there. So all the walls and the roof and everything is quite insulated in US, right? It can go up to like minus certain degrees, 10 degrees, 15 degrees and all. So need to make sure that the heating, what happens inside the house, is not leaked out, right? If there is a leakage happening, that means more energy is being consumed. So you can go ahead and make sure it's properly insulated, all the holes and all, that's it's been all properly covered and all. And or maybe do some paint, in the sense that during time of summers it doesn't absorb too much of heat. There are a lot of those things available. The weather is very different there. There are a lot of solutions available on how to make sure the energy is being efficiently utilized in the house. So any kind of improvement those are done, they're also eligible for. That could be simple expense like maybe $100, maybe $500. It doesn't have to be in thousands and all. That is eligible for credits. Then there's something called residential clean energy credit, um, which could be installation of solar electric property or water heating and geothermal and all those things, biomass fuel property and all. So they're also qualified for the energy credits. And I think what they're saying is, um, for anything placed in service in 2022 through 32, for next 10 years, up to 30% of the cost of the qualified property can be eligible for credits. So that's a very big amount. People can get pretty high credits for that. So again, the energy efficient home improvement credit is like, okay, they're giving some kind of limits here. It's okay, we don't need to really too much spend too much time doing that. But what we need to do is, any of the insulation, doors and metal, yeah, sometimes there is a small crack on the side of the door or in the window, so the cold air can come in and all. So I mean, like, even small things of repairs and all those things can also be eligible. Okay, then there are certain uh, certain like limits for that. So for again, that they're giving limits for different category. That for exterior windows and skylights, it could be like $200 and all, or the maximum credit is $500 and all. Again, those will be calculated automatically. We need to make sure that we are understanding what is eligible, what is not. We need to ask the client that provide us with the bill, show us what has been put up there. Just that maybe you're getting half work done, maybe you're changing the roof. Okay, the roof itself will cost $10,000, and then on roof you're also telling the roof person that, okay, why don't you also put solar panels? Maybe panels will only cost $3,000, but we cannot go ahead and claim entire 13,000. So it's very important to do our due diligence there and understand what is that, what is this expense claimed for. Or sometimes these vendors, they also give us a kind of certificate that whatever work we have done, that is all eligible for the residential energy credits. Then that's fine. Okay. That's fine. This is a simple one. Let's go to the next one. This is important. Again, premium tax credit. So premium tax credit, let me give you a little bit background on that. So Obama healthcare, when Obama was the president, he made it compulsory that everyone has to carry a health insurance. They went to the extent saying that it will be illegal if you don't carry it and you'll be penalized and all those things. Now, to force somebody to carry a health insurance is again not fair if the person is not able to afford the cost. So, what they did is they also came up with a scheme, said that, okay, we are going to give you some tax credits on that. If you are spending money towards this cost, we'll give you the credits back, provided your income is below certain level. And what they did is, instead of like asking the taxpayers to go to these private insurance companies which can charge like a bomb, they said that, okay, what government will do is they'll put up a marketplace Meaning, marketplace is something where there are a lot of vendors and a lot of customers, right? So you go there, visualize it as like you're going in a big hall. There are a lot of vendors sitting there, a lot of customers. You go through each one of them. Maybe there are 10 a little what do you call this, like how we go in the exhibitions and all, right? And there are people over there, so maybe there are 10 or 15 of them. You go to each one of them and say that how much will you provide health insurance for, or versus the other one, and all, and whatever best rate you find, you go and take it from there. So this is a government managed marketplace, so the rates are going to be quite low, and if you go through the marketplace and get the coverage from there, uh, US government will provide some kind of benefits on that. But again, then there is a limit that we have to see what is the federal poverty line. What is the poverty limit that below certain amount if person earns, then he'll be considered that he's in the below the poverty line. Okay, so the credit is available to households with income no greater than 400% of poverty line. So maybe your income should not be more than 4 times of the federal, whatever the poverty line has been laid out for that particular year. And we need to go for whatever is the lowest cost silver plan and all those things. Okay, the cost of insurance is capped at 9.61% of household income, so they'll also make sure the insurance cost is not going extremely high and all. Now there are two kind of things. We'll go through this thing a bit later, but this could be a bit confusing. Let me just tell you how it works. So there's something called advance tax credits or premium tax credit. That means when you're taking the health insurance, you can tell the government that, okay, in order to pay for this health insurance, I need some advanced tax credits. That means even if the year is over, you have still not filed your tax return, the government will give some, advanced credits. You can use that money to buy the insurance. But at the time of filing your tax return, you have to give a proper record of how much advanced tax credits have you received, what is that you're eligible for. If you have received higher than what you're eligible for, make sure you're returning back that money at the time of filing tax returns. And how do we do all that? There are certain forms, 1095s. They're called 1095s. Those forms are issued by the insurance companies and all, and those forms will tell what is the advanced tax credit, if any, given, what is the insurance amount that the person is supposed to pay, and the other details we can calculate, right, by looking into their W2 and 1099 and all that, what income level they fall under. Are they satisfying this condition or not? So that's why, and again, we have seen this, that the taxpayers have, or our clients have not provided us 1095s and all. They never told us about this form. Sorry, not this form. 1095A, Health Insurance Marketplace Statement. This is an important form. 1095B, how many months of coverage you got. There is a question which is clearly asked when we're doing the tax return. Do you carry the insurance coverage for all 12 months? If we are marking that as yes, we need to make sure that the health coverage statement is also marking the same thing, that yes, the coverage was there for full 12 months. If you do not mark that, there may be some penalties that will come up, saying that why did not you take the coverage? Okay, so now you're penalized for that. Then 1095C, employer provided health insurance coverage. This is provided by employer. If employer is providing that, they also have to give some form. But this is for marketplace statement. All these three forms are required. If we see a tax return that last year there were 1095 forms were given, and if we have worked on this form 8962 premium tax credit, we should definitely ask the client, did you also receive any of those statements this year, any of these 1095s? Because this information is with IRS, and if we miss on it, they'll within few days, within a week or two, they'll get a notice that you are not putting up your health insurance information properly. A lot of our clients are already covered by their employer health insurance plan and all, and probably they are quite above the this limit which has been given, 400% of federal poverty line and all. They are not even eligible for premium tax credits or advanced premium tax credits and all those things. But there might be quite a few those who are falling into this category. So what we need to remember is this is all about health insurance. They are supposed to carry a mandatory health insurance. If they cannot afford it, government has made a marketplace for them. They will get a health insurance at a very, very cheap cost. Go ahead and buy health insurance from there. If you cannot pay the insurance amount, ask for something called advance payments. Government will give, US government will give advanced tax credit. That means if you're saying that I will be eligible for $10,000 tax credit, they said, okay, fine, go ahead and take this $10,000. But then they are watching. After the year is over, that return has to be filed with proper information that you have received $10,000 and what are they eligible for. If they're eligible for only 8,000, they'll tell that, okay, give us $2,000 back. Okay. And a refund is available for taxpayers who did not receive any advance payments. There might be some taxpayer, they'll say, fine, I'll go ahead and buy insurance from marketplace, but I really don't need any advance payments from the government. I'll manage my own expenses. That's fine. Then they can claim a refund later whenever they file the tax returns. Maybe some of the people will say, oh, it's too complicated, I actually don't want, because if they give me advance payments, they're watching me very closely. I don't want IRS to watch me and all those things. So it's fine, I'll just claim whatever is due at the end of the tax year. So that's also fine. Again, one thing that we need to note is this is for people those whose income level is not very high. And now, since the government has come up with this rule that they have to carry mandatory health insurance. Why? Because if they don't carry health insurance, the state has to give them medical facilities. It gets very expensive for the government because healthcare is very, very expensive there. If they don't carry insurance, they cannot be just left on the road to die. So they have to. The government has to take care of them. So it's again all the taxpayers' hard-earned money which is going. So what they're saying is that everybody should care, take the insurance. So at least the insurance companies are covering up for some of the cost. And if you're not able to afford it, it's fine. We are giving you some advance payments. Take that, use it. If you're not taking that, we will still give you some refunds when you file the tax return if your income is below certain amount. Okay, then there are certain conditions for that, what they're eligible for. Obviously, you have to get it through marketplace. You should be ineligible for coverage through some other plan. It should not happen that there is some Medicare plan or some Mediclaim, some kind of plan is already existing and you're still going ahead and using marketplace. No, if there is a different scheme for you, maybe you are an elderly person, maybe you're disabled, maybe you have some state insurance scheme that covers you, then don't go ahead and use marketplace. Why? Because this is meant for people, those who really, really need it. Do not file a separate return. Married filing separately, they will not get the benefit. But there is an exception here for married filing separately if the taxpayer can prove that they are victim of some domestic violence and all, and they do not want to file, even if because the divorce or legal separation may take some time. Right? So maybe they're already started living separately and whatever. So if they can prove that, yes, there is a reason why they're not filing jointly, then that's fine. That can be taken. This condition is not there in other tax credits that we have seen. Or what was the other? Earned income credit and all, right? Those conditions, they clearly say that there has to be a married filing separately. If you're filing, those credits are clearly disallowed. On the face of it, just like, okay, no to that. But the health insurance one is giving some exception that there could be a genuine reason for not filing together. So that's fine then. Taxpayer must claim the credit by filing a federal income tax return. The they have to file a income tax return if they got any of these three forms. And taxpayer with insurance coverage will receive one of the three tax forms shown below. Okay, and that's it. I think obviously these are some general stuff. They should store these forms and all, and they can receive multiple forms also, multiple 1095 also if their health insurance coverage changed. Maybe they went with Blue Cross initially, then they said, well, I'm not going to go with Blue Cross, I'll go with um, Kaiser in another big company that provides health insurance or something else. So they may have multiple 1095 forms. So that's okay, completely fine. A person may have multiple W2 also if they're changing the job. So that's again nothing to be really amused about what's happening. The amount of the credit is generally equal to the premium for the second lowest cost silver plan available through the marketplace minus a certain percentage. So what they're saying is how will we compute the credit? So what they're saying is you go with the second lowest cost silver plan. There's some plans that they may call it as silver plan or gold plan or platinum plan or whatever, right? Depending upon what your needs and all. So what they're saying is go with the second lowest cost silver plan, and which is available through marketplace. So again, marketplace rates are all regulated by government. A private company can put up any cost they want to. They said, oh yeah, we'll sell it for $500 a month. But marketplace is something which is regulated by government, that if you are providing this silver plan, which may include, say, um, complete health insurance, dental insurance, vision insurance, that is the kind of, maybe some criteria is given. So that is the amount that you can take. We'll have to see what is the household income. Take a percentage of that, do this calculation. That is the maximum amount of credit that you can claim. But again, those calculations, see, these marketplace insurance company will do that. They have been given what is the rule, because they're also helping them to get advance tax credits. Or if they are not doing it, this is the form used, form 8969, 8962. We have to put in the correct information. It will calculate, it will take into account what is the household income. Are you above the poverty line? By how much? Or are you below the poverty line? What is that monthly amount that you're paying? How many dependents are there? That is also being captured in the plan and everything, right? Because we are putting all the information in the tax return. The entire family information is there in the tax return. So what they're saying is, obviously, every credit has to have certain guidelines. Now, what is the maximum that you can claim, and how to calculate that and all.
Okay,
That's
so
what it is.
that certain percentage is calculated automatically. That certain percentage of household income.
Yeah. Depending upon all other factors.
Okay, ma'am.
But the cost of insurance should not go above this
Um,
much of household income, because at the same time they want to make sure that it should not be that expensive that you end up paying like 30% of your income there. No, then that's not fair, right? For the people, they're earning hardly, like, some meager amount, and then big amount they're paying towards the insurance. That's also not fair. So if the government is regulating that, they will make sure all these things are taken into account. If a private company is doing that, they don't care about household income and all. They'll say, well, our plan is 500. You want it, you don't want it, fine. Take a call.
okay,
And
ma'am.
so that's why it was getting very, very expensive for others. And there's so many people, those who are unemployed, those who don't have employer coverage, those who, or maybe they're working, doing very, very, simple jobs or menial jobs and all. They're not able to get the coverage. So the whole idea is that in America, people should not suffer because they don't have a medical insurance. Everybody should be able to go to the hospital, to the doctor, get treated. But the government cannot go and tell them, the hospitals, that treat them for free. Again, that would be abused. So this is the system that they came up with, that you provide us with the proof of all your income and everything, prove that you are not able to get any insurance from anywhere else, Then if everything is proved, then we will go ahead and will provide you the insurance at a very reasonable cost. Okay. And we'll also give you credits back so that there is minimum amount of cost that is going out of your own pocket. Is that clear now?
Yes, ma'am. Yes, ma'am. Absolutely clear.
Okay. All right. So we'll stop here if no other questions.